because sometimes you'll be talking. All right. Hey, how you doing, Troy? So I guess we're good. I don't even need to check. I was going to see if we were good in regards to going live. I typically like to check on the my YouTube, but I'm gonna make sure just to make sure. But thank you guys for joining tonight for this live. It's Ask a Lender Live. So we have our lender here, Demetrius, and he will be able to answer any questions. Again, we want to try to keep them very basic because when you start getting into certain lending questions around different states, it might be kind of different states per se with certain specific questions. However, if you have generalized questions or questions that you would love to get answered in regards to lending, this is the purpose of having this live structure in which you guys can come in. You can ask questions. Let us know in the comments where are you listening from or viewing from, and we're going to get it started. I am, if you guys don't know me, my name is Devon Clark. I am a local realtor in the metro Atlanta area of Georgia. I can also help you when it comes to different states, but I will refer you out to another agent that I possibly know in that state. I cannot help you buy or sell in the state, but I can definitely refer you in the right direction in those states. And to my right on the screen, depending on which way you're looking at it, I have Demetrius Lockett. He is a lender. And if you can introduce yourself, Demetrius, to the our folks that we have on live.
Absolutely. First of all, thank you, Devon, for having me as part of your podcast today. I am Demetrius Lockett with Southeast Mortgage. I am a local lender, loan officer to help people get approved to be able to purchase their dream home or their investment home or their second home, but primarily to get financing and help people with their credit.
Okay. So you hear that, you guys. Again, he is a lender. So ask your questions, put them in the comments below. But I'm going to start off asking questions, which is the typical questions that I think everybody should be asking the lender. Demetrius, what type of loans are available when it comes to someone looking to purchase a house?
Okay, that's a big question. Much longer than a 1 hour show. So what I will do though is talk about what's common for first and second time home buyers, because I think that's probably where your audience is. The most common is FHA. FHA is a mortgage that is backed by the Housing and Urban Development, or HUD, which most people have heard of. And it tends to be the most lenient. I'm sure we'll talk about that more as we go into the show. But FHA, conventional, which requires a little bit more credit and sophistication of the borrower, I guess I would say, from a credit and employment standpoint. And of course, there's USDA and VA, both which are government-backed mortgages, which allow 100% financing for different audiences. But those would probably be the four that I think we would mention most. Of course, there's other ones, but it's kind of like a suit. You kind of figure out where you are. Most of the time, your first and second time home buyers are going to be either having challenges with credit or coming up with so much money that needed a lot of times on the purchase. So that's where those mortgages can kind of work with you and also allow some down payment assistance possibly if people need that as well.
Okay. So we're going to ask a question that Kenya has here. How you doing, Kenya? She said, "I heard the market is turning into the favor of buyers. If is this true? How so? If this is true, how so?"
I would say that is partially true. Kenya, hello, how are you? Thank you for a wonderful question. That's very good. And I would say, going back to Devon, what you said earlier, depends where you're calling from. Real estate is very much local. Not one national thing fits everything. I would say, at least for the Georgia market and some of the southern states like Charlotte and Nashville, real estate has remained pretty resilient because of the job growth. I mean, a lot of people in the Georgia market are hoping that it will come down and become lower. But to be quite honest, as high as our prices are, they're still lower than a lot of competing cities that are like in Atlanta when it comes to housing prices. So I would say that those will maintain their prices or go higher. And then also, you'll find that the interest rates are not moving as quickly as the prices are moving. So that's not making quite a big impact for the buyers. Where I am seeing some benefit is that I am seeing some of the properties stay on the market longer, which always usually is a benefit towards adjusting a price or such, which I'm sure Devon will mention more about. And also, I see that the sellers, from based on the contracts that I've been receiving, tend to be more negotiable for buyers in terms of paying closing costs and making repairs or doing those kind of things that will benefit you in the long run. So if there's any kind of thing for Georgia, I would say that would be a benefit or in favor of the buyers, is that they now have some help paying for the cost, which normally can be very expensive for it to be able to carry by yourself.
And so Kenya, she is actually in Georgia. I know Kenya. I invited her on here tonight. So thank you for joining, Kenya. And don't mind us to the StreamYard. Sometimes the signal goes in and out. So be freeze for a moment. Don't run away. We'll be here for an hour. Just be fresh and we'll hopefully pop back on. But we are going to answer a couple more questions. Then I'm going to ask Demetrius some more questions, because I know I had told him what questions we were going to ask, but I knew that this was a great thing for people to jump on, ask their own questions as well. So we had James Clark here, and he says, to the lender, does someone who wants to buy a house in Georgia but lives out of state, what's the qualifications?
Great question. It depends. It depends on what your job is. It depends on the responsibility. There's a couple things that you have to look at when you're buying a house. One, is it going to be a primary residence or is it going to be an investment? And the lender's got to figure out which one it is. A primary residence means that you're going to live in it most of the time, as a place that you sleep and work from, or sleep and like show up most days or most nights. An investment property obviously would be less of that, and sometimes that you're using as income producing property, or possibly it could be a second home. First, we've got to figure out which threshold we're looking to get. But I'm believing that you're talking about, James, let me know if I'm wrong, you're talking about if you want this to be your primary residence, to have a house here in Georgia. So let's say, for example, you were a truck driver, and you like moved all over the place, but you had to have one place that you called home. It could be Georgia, as long as you didn't have another home somewhere else. Or let's say, for example, you were a veteran, and it required that you had to go out of the country, or that you were dispatched to different places. You certainly could have a home, someplace that you wanted to call home, or someplace that you had family to satisfy that. So it just depends. If it's your primary residence, you're looking at a down payment as low as 3.5% to 5%. If it's an investment property, you're looking at about 20%. And if it's a second home, you're probably looking at 10% down payment. So it just depends on your particular situation.
So I have a question in lieu of that. Before we get to Andrew, thank you, Andrew, as well for joining tonight. We'll get your question up in a minute. So when it comes to the amount in which someone puts down, so I know you talked earlier about the different loans for say for first time and second time home buyers, FHA, USDA, VA, and conventional. What would be, I guess, what percentage would each one of those loans, the minimum per se, would someone need to put down to actually be able to kind of get in that space of utilizing that loan?
And you mean of the four that I mentioned earlier?
Correct. Yep. Mm-hmm.
Okay. We'll start with FHA. And I'm starting there, obviously, because that is the one, as we talked about earlier, that is the most used and the most normal for first-time and second-time home buyers. FHA requires 3.5% down payment, 3.5%. Conventional is another alternative when your credit becomes higher, like over 700 or over 680 at least. You can put down as little as 3%. What's typical is about 5%. But there are programs that allow you to put down as little as 3%. That's for conventional. The other is USDA. USDA is a rural program that allows you to put down 0% for down payment. And VA is obviously for veterans, spouses of veterans, and that allows you to put down as well 0%, based on the fact that you served the military and have a certificate of eligibility.
So yeah, because I know sometimes people have a myth in their head where they think they got to put down 10 to 20% per se to be able to buy a home. And we know that that's not the case. Like you said, with FHA, you can put down as little as 3.5%. And like you said, conventional, you can go to 3, typically usually around that 5% range. I know most people put the 20% down to avoid, for conventional per se, to avoid the PMI, which is the private mortgage insurance.
Yeah, Devon, it used to be a time where you could only buy a home by having 20% to put into the property. So,
Okay.
and that was obviously some time ago. Um,
Mm.
but now you can put down, like you said, as little as 3%. And the gap between the what you put down and 20% is what mortgage insurance covers. It covers the gap between those two. That's why so many people still think it's 20%, because obviously they're listening to, grandparents or people that bought homes some time ago where there was not a choice.
Mhm.
Um, but yeah, there's a lot of programs. You should not let the fact that you don't have enough money be one of the reasons that you don't pursue home ownership. Because there's a lot of programs out there that can help you get started in the right direction and save you a lot of money as well.
I agree. So now we're going to go on to Andrew, if he's still here. Thank you, Andrew, for this question. He asked, if you work in sales, how do you suggest applying for a mortgage? I have a base salary plus commissions. Do I use my base only?
Hey, Andrew, how are you? Um, I know what sales is like, not an easy job, so stick in there. What we do typically is, especially if you're getting commissions, it's almost like a self-employed person. So what we'll do is we will take your last 2 years, typically of tax returns, but there are sometimes that we can just take a statement from your employer. What we will do is average the last 2 years. Um, we'll take your base salary and then average your commissions and come up with um, one amount. So no, we won't just use your base salary. We'll definitely want to use your commissions, and oftentimes that's where the real money is. So we definitely want to use that as well.
And then I have a lot of questions for Demetrius too. I had told him some questions before we jumped on, but you guys I know this is more important to you guys because you guys are in search of trying to do things around home ownership. So I want to make sure I kind of intertwine the questions you guys have and questions that I have to hopefully feel more, create more knowledge in this particular live tonight. But Kenya has a question around, is there a credit score minimum for USDA loan for first-time buyers for primary residence?
Great question. There you are again, Kenya. Actually, the recommended score is 620, but USDA does not have a minimum score. The reason I say that is they're one of the few credit report mortgages that still allow you to build a credit report, which means if you don't have anything on your credit, we can look at your rental, we can look at your utilities, we can look at how you pay other bills in the last 12 to 24 months, add it to a credit report. And of course, that does not produce a score. So no score also works. Now, what does not work is your 500s and 400 scores because you haven't been able to pay things on time. But in terms of having a score, to answer that question, there is no minimum score. There is such thing as a bad score, and that's not what we want. But like Devon was saying, as you guys have questions, it's very normal. Hopefully, you can tell that I'm a very normal person too. So it's just picking up the phone. I'll be really happy to answer any question for anybody at any time because it is important.
Yes. And I'm gonna put when we finish this live as well, I'm gonna actually put his if he allows me to, I'll put your information in like the description below. So anybody that comes to see it afterwards, anybody that sees the replay, you can go down into the description below and I'll put Demetrius his name and his email address. So then that way you're not getting no random calls, but hopefully you'll get great emails.
Absolutely.
I don't put my number on YouTube either. I know some people do until I get like a different line. Because I get somebody actually called me. I don't know how they got my number, but they called me from Colorado in regards to like they saw a video that I had. And I know it's easy to get anyone's number, but I was like, okay, wow. I usually get
Yes,
emails. I never got somebody to call my
it's
phone.
easy to get your number.
Yeah, it's easy. Yeah, I tell everybody I could get anybody's number. She said, so Kenya said, oh, wow, that's interesting. Thank you so much. Great information.
Absolutely. Let's get you in that house, Kenya. Let's get you in that house.
I know Kenya had a big thing because I talked to her a few months ago, her and her husband, and I know she wanted to kind of possibly use the approach of the USDA type of loan. So hopefully she'll ask more questions tonight in regards to USDA so she can get a little bit more information. She does know that there are two different, parts of USDA as far as loans, like the direct and the guaranteed. And but as a lender, you guys kind of use the guaranteed more than the direct, because direct you're going directly to USDA, right?
Correct. Now, all of them would have to be obviously guaranteed, but typically, as a lender, for most of us, what they allow us to do is to make the decision on their behalf, go ahead and get the loan closed, and then they'll guarantee it afterwards, upon looking through the file and knowing that we've done everything that their standard asks them to do. Sometimes we too will have to send it directly to them, but that process is longer. It's still some of the same stuff, but obviously they have ultimate power if there's ever a marginal situation where it could possibly be approved and possibly not.
Okay. All right. Again, if you guys are joining us, please, if you have any questions, put them in the chat, and we're going to just keep rocking and rolling, because I appreciate you guys coming on and actually, you know, allowing to get any information answered that you might have been thinking lately about. So Troy says, if I am using the VA loan, how long do I have to be on a job before I use the VA loan? I'm not active duty. I'm a reservist. A reservist? Am I saying it right?
Reservist.
Yeah. Okay.
He's a reservist.
Okay.
That means he's in the reserves. That's all.
He's in reserves. Yeah.
Yeah. So, thank you, Mr. Alpha, for your question. When you say how long do I have to be on a job, I'm believing that you're calling your job the military, or do you have a job outside of the military? So I'm going to assume that you have a job outside of the military, and you're also a reservist. So it comes into a couple of questions. One, we have to find out if you have ever been active duty, how long that time has been, if you were discharged, and if you were honorably discharged. And all that I can find out in a matter of about 5 minutes in a little piece of an application. The other, if you're a reservist, there's a certain number of years that you have had to been in the reserves to qualify for this privilege of buying a house with no down payment. I'm not positive of the number of years. I need to go back and look at that. I think it's 7, but it might be as low as 4. So don't quote me on that. I'll get the information back to Devon so that we can know. But in terms of how long you have to be on the job, that's not the reservist or active duty, there is not necessarily a requirement. Typically, we want to see 2 years of employment, but and again, you'll hear me say a lot, it depends, because really doing a mortgage is as individual as anything else you can think that's very personal. There's so many factors that go into it. So I'm trying to make blanket statements that will control or at least work for most people. But if I say something and it doesn't sound like it answers your specific issue, make sure you come back to us so that we can get you the correct answer. But we typically look for a 2-year work history. But if you're just getting out of the military and you started your job a month ago, then you being in the military is also work history. But if you got out of the military 3 years ago, and for the last 3 years you've been, unemployed, then we would have to wait for you to at least be there for 6 months or longer.
So he said I'm still in, and I was 5 years active. I'm 14 years in, and 80% disability. So he doesn't currently have a job right now. He'll be looking for one in Georgia. So he's wondering if he gets a job and still have all this behind him, he'd be able to buy a place.
Yes. Thank you again for your service. What we will want to see is that you were back working at least 6 months. One thing to note, getting a VA loan is you say you're 80% disabled. And if that's through VA, which means that you probably get a check, that's a thing that is to your advantage in terms of the VA loan, and that you get waived that mortgage insurance, or it's called a funding fee with VA, but very similar in terms of how it works. That gets waived for you, and that's several thousands of dollars that you get to save. So that is one benefit of that. And also whatever disability income you receive also is looked at as income. So that employment would be additional income that you could count but we need you to at least be there for 6 months to show that you're back into the workforce and not just back to work to buy a house, is the general theory.
Okay, so you hear that, Troy? At least 6 months. Okay, so James said, if I apply for FHA loan, do I have to live in Georgia?
If you're applying for an FHA loan for a property that is in Georgia, and you're saying that you're going to buy it as your primary residence, and yes, you have to live in it. If you're buying a piece of property in Georgia and you're buying it as your second home, you have to only live in it part of the time. If you're buying a piece of property in Georgia and you're buying it with the intent purpose of making money and renting it out or using it as an Airbnb, that becomes an investment property, and there is no requirement for you to live in that property ever. But if you're talking about to do it as a primary residence, you don't have to be able to live here, but you'd have to answer the question. I mean, you wouldn't have to necessarily, but if I apply for an FHA loan, do I have to live in Georgia?
So I guess he's saying more of like, I guess he's saying more like, if I live in, let's say, Pennsylvania, but I want to buy a house in Georgia, do I have to live in Georgia? Typically, you would, but because like FHA, like you say, you got to live at least a year.
FHA does not do investment properties. So unless you were buying that house to live as your primary residence, you couldn't do FHA. So yes, you would have to live in Georgia to do an FHA property in Georgia. Let me know if I didn't answer that thoroughly. I'll be glad to talk more about it.
Yeah, if you guys feel like you need more context around that information, just keep putting your questions in the comments. Troy said, he said, thank you. And so we're going to get to some questions that I had as well. I know I had said this already, Demetrius, but like I said, we're going to intertwine it. If you guys are watching this back later on, just remember to put any comments or questions below in the comment section. You can also find Demetrius' email address side of the above underneath of the video if you want to reach out to him and ask additional questions. So Demetrius, when it comes to utilizing an FHA loan, how much closing costs can someone get in regards to an FHA loan? And then we'll kind of go down the line with the 4 loans as far as closing costs.
Okay, closing costs. And I'm going to expound on that a little bit if it's okay, Mr. Clark.
Go ahead, please.
A lot of people think about closing costs and down payment, and that's all they think about when they're talking about buying a house. There's 3 important things. One is the down payment, which we talked about a little bit. The other is closing cost, and the other is prepaid, because you have to set up an escrow account for taxes and insurance. And be mindful that closing costs are just that. It's the cost to close the loan. So it doesn't necessarily matter on which loan type, even though some of the special programs can be more expensive. And of course, as you spend more money, like over $600,000, from a percentage standpoint, it comes down. But typically, closing costs in Georgia type areas runs about 3% of the sales price. Sellers can pay up to 6%. And so some would say, if they only range about 3%, why would you get more? Well, a great agent like Devon has gotten more previously because it allows the seller to help you as a buyer pay for part of your closing costs as well as setting up your escrow account for tax and insurance. That's not normal. That's why it's important that when you're looking to team up with your real estate team, that you make sure your realtor is creative and has your best interest at heart. You know, asking what they've done for other people. And working with Devon, I can tell you that he looks for ways to creatively, legally, and to your benefit, be able to get the most out of this process. So yeah, you can spend up to 6%. Typical is 3%. Anything outside of that can be used for buying down the interest rate or helping to set up your escrow account. The only thing you absolutely have to have that's your own is the 3.5%, which is the down payment. When I say your own, it can also be like $1,000 or something like that, but the seller can't pay it.
Okay. And so then I'm going to expound on that a little bit. So
Please.
I just recently, I reached out to you, me and Deborah, a co-agent of mine, and we were working on a house in Marietta, Georgia that we closed on Friday, which was a good thing. And I know that
Congratulations.
you've done some recent closings too, so back to you as well.
Thank you.
I know in this situation, the buyer had a conventional loan, and with his conventional loan, he had put down about 25% to pay for it, so he was able to get like a larger amount in closing costs. I think the when I looked up the lender, he said at least up to 9%. So with conventional, you like I know he said with the percentages, like if he put down more than 10%, he could get up to 6%, and then 25% he can get up to 9%, and then below that would be like below the 10% was 3%. So with conventional, you can kind of utilize the different percentages when you put down a certain amount of down payment. Is that correct or no?
Yeah, that is. To his point, anytime that you put more than 10% or more, then we can increase the amount. And when we say we were, according to Fannie Mae and Freddie Mac, who determine how everything is structured, we can allow them to pay up to 6%. What's typical is 3%. Very typical. And the reason that is because they're feeling, remember I said that a conventional loan typically is going to be a little bit more challenging to get than a normal FHA loan. That's one of the barriers. They believe that this buyer has enough to set up most of their own stuff. So they don't give them as many incentives because these people are strong. And even in the case of you having someone that's putting down 25%, typically the last thing that person cares about is who's paying the closing costs. Because they've got money. They can pay their closing costs. They're looking to get some kind of a sweeter deal, either on price or on rate or something like that. So it just depends. And usually you don't have someone needing that much money that's going conventional. Usually that's an indication that they're going to go or need to go FHA. But yeah, they can go based on varying amounts. They can pay more, but typically it's 3%. On FHA, it's 6% across the board, regardless what you put down.
So if you see me typing on my phone, don't worry about it. It's my cousin. She's trying to chat in the chat box, but for some reason it's not showing up. She said that she put a question here, but I don't see it. So if I look down with any questions she has, then that's what I'm doing. So don't think I'm being rude. So because she has a lot of questions too around the lending process. So again, that's the purpose of this, to have you on here. We thank you for giving us your time tonight. And so now I'll ask another question, because what's happening now lately is that I know with the interest rates kind of being stagnant and being complacent, like the 6%, it moved up to 7%, depending on the conventional loans, blah 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 blah. I should say blah 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 blah, but in that area. But with that being said, when it comes to a person wanting to buy down their rate, because I know people have asked me about like the buy downs, buying down the interest rates. Do you think in this market that we're in right now, do you think it makes sense? Or if you can kind of, I guess, lay out first, what is a buy down, and if it makes sense in this market currently?
Yeah, absolutely. That's a really great question that people really are asking a lot these days and absolutely get confused about. A buy down is just what it sounds like. You're buying down what the standard interest rate is to something lower. Usually between mortgage companies, there might be a difference of an eighth or a quarter from one rate to another, from a mortgage company to another. But typically, if you want to buy something lower than what the rate is, the market produces a rate sheet. And typically, one discount point is equivalent to somewhere about an eighth or a quarter to the rate. It's not 1-to-1. So in other words, for example, you're buying $100,000 house. The rate that you've been approved for and what the market is 7%. But you say, I want something lower. And we say, okay. And we tell you how much that's going to cost. That amount is called discount points. So let's say it was one discount point. And one would be $1,000, 1% of the price. And it would make a difference of about a quarter. So instead of 7, you might get 6.75. but it depends. It moves. Rates literally change on a daily basis. So it just depends on what the market is doing, what indicators are coming out, and those kind of things. Do I think this is a time for right now to buy down the interest rate? I would say probably not unless you're looking at this being for your forever financing vehicle, because we all know that rates won't stay where they are forever. At some point, they'll come down. Even if they come down just a point, somewhere in the fives, there will be times where you want to take that investment, that money that you have, and get it at a cheaper rate. So it just depends on how long it will take you to recoup those discount points in terms of how long you would have to stay in that mortgage for it to make sense for you to get that money back. And typically that payback time is going to be longer than 4 or 5 years. And we know that within 4 or 5 years, we hope, at least all the mortgage guys hope, that the interest rates will come down so that we can refinance your mortgages and get you into a better position for you and your family financially with the lower rate. It will happen generically. Instead of having to buy it down.
And that's what I typically say. I have a question here too, and George just put one in as well. But my cousin sent me a question via text. But that's the thing I've been telling people too, because we've seen like a lot of new constructions where they're given these incentives, and one of the incentives might be a lower interest rate, or it might be a buy down. I've been seeing more of like they advertise it as a lower interest rate, but then when you actually dig into it, it's like a buy down type of interest rate. So I always tell people, if it's a 2-1 buy down, a 3-1 buy down, and I know people are like, well, what is he saying about that in regards to that? But basically, if your interest rate, like, if it's 7%, and if it's a 2-1 buy down, it'll go to maybe a 5% the first year per se, and then 6% the second year, and then the third year it'll go to whatever the market rate is per se. So what I tell people is like, if the market was to stay at 7% in the next 3 years, could handle this interest, this mortgage. And if you feel like you won't be able to handle something like that, I would suggest find another way. I would suggest maybe buy a cheaper house that makes more sense to what you can mortgage wise. Because the whole thing, like my whole goal as a realtor, honestly, is not to get people caught up in anything when it comes to their house. And then also, I don't want no one to foreclose on their house. I don't want anything to happen. Like, I want to put you in the best situation I can put you in. And whatever you do after that, if you start messing around, I can't control what you do after I help you get into a good situation. But my goal is not to just to put you into a situation that you might not be able to handle, because we know taxes go up, property taxes, especially in this era, we've been seeing, because of homes increasing, the taxes have been going up, astronomically. And then on top of that, you get home insurance going up because of the weather disasters happening in different states is getting added on to everybody's insurance, even though people might not see it. But I even heard people say that it got added onto their car insurance. But like, these things change as you go on. And then if you're in an HOA, with prices going up, they're going to probably have to, up those HOA fees. So I just tell people, make sure when you're buying a home, it's not saying don't buy a home. It's like, just try to put yourself in a good situation, because if next year the things increase, you'll still have a cushion there to be like, okay, hopefully, maybe you'll get a raise at your job or blah, blah, blah,
One of the things that I can attest to, Devon, and as you know, I've been doing this for a couple decades at least. And there's some realtors that the sale is everything. I have personally seen you walk away from a transaction when you know that it did not benefit your buyer. So
yeah,
pretty cool. That's pretty cool. I think it will come back to you, because you don't want to put somebody in a situation where they're, house rich and then they can't go and have a burger somewhere. So kudos for that. And also the buy down, just to reiterate, that is nothing more than you, again, it's like discount points. You're paying in today's dollar what the difference between what that payment at 5 is and the payment at 7 is. There's a dollar amount, and all they're doing is paying that in there. And it's very hard to compete, unfortunately, with a lot of the subdivisions, because they have, even though they say they're giving it to you with some of their preferred lenders, is they've already built that into your house price. So it's already a benefit that you should be getting regardless where you go. But that's how they do it. And oftentimes a buy down can be very, very expensive. And the reason that we sometimes do it is because we want to be able to get people to be able to qualify at a price lower than what the reality is going to be. So, just be careful and listen to Devon's wise counsel, because I think that does make a difference. Not just being excited in the moment because buying a house is absolutely the best thing in the world, but
Yeah.
able to look at it objectively to see what's going to happen a year down the road. So I agree with that, definitely.
I'm gonna partner this with this since we're in this conversation, then I'm gonna ask my cousin's question. So it says, are buy downs permanent or temporary? We kind of explained it, but if you can kind of touch on it a little bit more, and is it worth
Sure.
doing? So you
Sure. Buy down is just that. It's a temporary buy down is what it's typically called. A permanent buy down, you could do that too. But when you permanently buy down the interest rate, that's called, discount points. But a temporary buy down is just that. You heard Devon mention 2-1 or 3-1. And the first number just talks about how many times it will adjust. The last number means absolutely nothing to you. So if it's a 2-1, that means it's going to adjust twice, 1%. So you would go, if you qualify at 7 or your final interest rate is 7, that means you get 5 temporarily for 12 months. Then it will adjust to 6 for 12 months. And then it will adjust the final time at 7 and stay there. If it was a 3-1 buy down, temporary buy down, it would be the same thing, except instead of starting at 5, it would start at 4, 5, 6, and then settle at 7. But again, those are real costs that somebody's paying for you to buy that rate down. If it really doesn't mean that much to you, maybe it means more to have your taxes paid for, or maybe it means more to have your insurance paid for. You're not worried about, $20 difference in your payment, especially when you have the stability to put that into your budget, moving forward forever. So just kind of things you need to look at. And you had talked about before about loan estimates and those kind of things. It's really important that you talk with your mortgage person. They're part of your team. That's why it really needs to be somebody that you can speak with and feel comfortable around, is because you need to be able to ask them any kind of question that you possibly think, and they need to have your best interest at heart. And the way that you know that is that they've helped other people to do the same thing that you're looking to do. Because this, unfortunately, is one of the few industries where you can get cheated and you don't even know until after it's over. So having somebody like Devon, who is not scared to step into the space and be a fighter for it, it's good. Everybody's not like that.
well,
Enough of you, Mr.
like of course, if you guys don't know, I got in contact with Demetrius through a buyer that I'm working with, and he's been an excellent lender through the process. So and very informative. And like I said, me and a colleague of mine, we called him when we were going through another prop transaction. So if you guys are looking for a lender to, that ask questions to or to utilize during your process, he's a good lender to kind of work within the Georgia market. And like I said, I'll put his information below. Whoever watches this back or just wants to reach out and see how they can, get guidance through the process. Because like you said, buying a house is I always tell people it's a tedious process, but it can be worth it in the end as long as you stick through it. And also there's different things you learn, right? Because I know some people I've had clients that come to me that gone through down payment assistance programs and took home ownership workshops, and then they get to me and I start laying stuff down. I'm like, oh yeah, I know that, and then, but when we start getting to like the nitty gritty of the buying process, like, wait, I didn't know I had to put this money down. I didn't know I had to do that. They don't realize like the different things that kind of take kind of move along the home buying process. So
and it's a lot. It's a lot.
Yeah, it is a lot. So my cousin, I'm reading the phone. She says, "What do lenders look for on your credit score to be acceptable, to be qualified for a mortgage loan from the lender?" So, what credit score wise, I guess, do they look for? What trade lines or anything?
Okay. So, since each one is just a little bit different, we're going to talk about FHA. FHA tends to be the most lenient. So anything outside of FHA might be just a little bit harder. But for FHA, we're looking at a credit score. Typically, the sweet spot, and when I say sweet spot, where all of the benefits are, you want to have a 640 or higher.
Okay.
You can do mortgages with as low, supposedly, as 580.
Okay.
And I say supposedly because it's 580, assuming that there's nothing bad on your credit report and you have other compensating factors. And in my 30 years, I have seen very few people get a 580 approved. It's kind of like a dream. The good news is that a lot of things have changed so that we can look at your 580 today and tell you what it needs to be to get you to at least 600. Once you get to 600, it's very much doable. They want you to have more savings and those kind of things, but 600 is what I would call the minimum. 640 is where you want the standard to be. And remember, the higher your score is, the better the interest rates are, the higher your ratios and things can be. So they can make more exceptions as your rate, as your score, is better. But at least 600 is what you want to see. Did that answer the whole question?
I hope so. If not, Lang, just send me another text. Because for some reason she can't talk inside the comments, which is weird. But she said, "What do you recommend? What do you recommend to build your credit?" So she's saying, I guess she's saying, what do you recommend her to do to want to build her credit to get a little healthier?
Okay, so when I hear someone say build their credit, what I'm thinking is you're saying, you have no credit and you want to build it. And then there's the other thing, which we'll talk about in a second. But you have no credit, you want to build it. So the easiest thing is to get a secured credit card.
Okay.
A secured credit card you can usually get from your bank. If you can't, there's a couple other institutions that I will tell you offline, since I don't want to advertise for them here on this podcast, since they're not paying for that. But we will, how a secure card works is that you go in, you put an amount of money down, usually $300 as the minimum, to your bank. They open up an account similar to a savings account, and they issue you a credit card that reports to all three credit reporting agencies, just like a normal credit card. I had a borrower who was building credit, as we called it. She had one account. I think it was, I don't even know what it was. It was something real simple and real small, and she had used it some time ago. And her score was like 578, which made no sense because it was perfect. The problem is she didn't have anything recent. So she went in to get a secure credit card. And I told her to call me back after she got it. And we did a couple of things. And in 2 months, she had a 647 score, and she closed on her home. So a lot of times there's things that we can do to build. The other thing that often people get confused about is you don't need to have a whole bunch of credit to get a house. You need a score, and we need to see some history. When we say history, we want to see 12 or 24 months of how you pay people. And we can look at your rent. Your score is 620, and you've got a Macy's card or some other card, and you've got this secure credit card and you pay it on time. Great, let's get you a house. The other myth that I think is important to point out, Mr. Clark, is you don't have to have been a renter to become a homeowner. What does that mean? I don't have to have paid rent at my parents and be able to document it. I don't have to have rental income. I don't have to have lived in an apartment to be able to qualify for a house. That is not one of the qualifications. In terms of how much house can you qualify for, because I'm sure people are wondering that, just in case we run out of time, is a good thumb to look at. Is take your gross income. That's the income that you receive before taxes are taken out, and divide that by 2. That is the most that you can spend on all of your debt as far as we're concerned. So let's say, for example, you make $1,000 a month. Half of that, or 50% of it, or dividing it by 2, would be $500. $500 would have to be the most that you can spend on your house and all of your other credit debt. So, as a word to the wise, keep your debt down low, because it allows you to qualify for more. That's how you can have 2 people that sit right next to each other at Coca-Cola that work together, that make the same amount of money, and one can qualify for one thing, and the other qualifies for something much less. That's because they have car payments and credit cards. That's why you often will hear that we say keep your debt low. Another misnomer that people sometimes hear, if you don't mind, Mr. Clark, that I'll mention, is we don't look at how much money that you owe outstanding. We look at what your minimum payment is. So please, if you are one of the educated consumers, and I know you are because you're on this podcast, is if you're working on your credit or you're looking to buy a house, do it with an expert, someone like me that has to be licensed through the state to be able to tell you, not necessarily tell you what to do, but tell you what your impact does or what you do impacts your decision to buy a house. I'll have people all the time that have been working on their credit for a year, and the things they're working on are those things that we don't really care about. So they've wasted a year and resources that otherwise could be used towards their tax deduction of already being into a house. So don't try and do this thing alone. It's way too big to do by yourself. Plus, you get us for free, so might as well take advantage of it.
This is my YouTube real estate buddy, Christina Smallhorn. She is a big real estate agent in Louisiana and has a wonderful real estate platform. I've gone on her show a couple of times. Hey, Christina, thanks for joining us tonight. I appreciate you jumping in live and supporting. As always, she's wonderful. So we're gonna go to Kenya, then we're gonna go back to James, because I know James had a question, but we kind of answered some of it, but I'm gonna get these ones and then Lang text me another one. We're trying to be here until 7:30. If we go over a little bit, hopefully Demetrius don't mind, but if you guys have any questions, put them in the chat. So Kenya said, is it common practice to pull from your 401k for down payment?
I won't say that it's common practice, only because nothing is common in this business. I will say it's one of the opportunities or options that you can use for your down payment. A lot of people don't know that in most cases, you can use your 401k, the money that you've been saving and investing. You can borrow from that and use it towards your down payment to buying a house. I have many people that do that, especially for their first home, because you can do it in such a way that you can still pay yourself back in terms of not messing up your 401k investment. So yeah, that is one of the common practices. Some of the other ones, since you asked, if you don't mind, is a gift from a family member, can be for all or some of the down payment. I have people that recently have gotten married, so instead of giving them toasters and microwaves, they asked for a cash registry. We were able to determine that and use that as the money they used for down payment. You can also sell property, obviously, if we can prove how much it's worth. There's grants and down payment assistance programs that often help. Sometimes Fannie Mae will have special incentives. Sometimes HUD will have special incentives. But of course, the best way to know what works for you the best is to be in the game. So of all the things that I recommend, get in the game, because you'll find that everything will start flowing in your direction, which is what we want for you. Thanks for a great question.
And that's the thing, like you said earlier, like real estate is very personal to the person. It's not, it doesn't, well, in life in general, right? Everybody has their own personal situations. So it's like, unless you inquire about it or ask a question around it, you won't personally know. You might have somebody else that you feel they might have told you their bad experience with it, but yet you go and it's a positive experience, right? So it's like, it's very personalized. And if you have that dream of wanting to be a homeowner someday in the future or currently, just ask the professionals around. It doesn't hurt, to reach out to like a Demetrius who's a lender and just ask some questions. You don't have to fill out an application right away. Of course, that would be the next step to take if you want to actually pursue the process of homeownership. But you can always reach out and ask questions. There's so many people that will not ask questions, and it's crazy to me. It's like I guess maybe because they look at real estate sometimes where they feel like people's trying to sell them something all the time. And I tell people, most realtors, if you're around a good realtor, a good mortgage person, anybody in a home like real estate professional, whether it's the lender, the mortgager, the appraiser, or whoever is in the process, if you just ask a question, they're more than happy to answer the question. Everybody's not trying to sell you to buy a house, and I appreciate the people who reach out to me that feel comfortable, like, Devon's not trying to force me to buy something, right? Or force me to sell my house. They're just like, I have questions. And that's why they also jumped on this live tonight, because they know that I'm not trying to force them, but they have questions and they're comfortable enough where I'm glad that you guys trust me to come on here and just ask these questions to Demetrius, who's a lender. So I appreciate everyone's time. And, and Christina said, you're my favorite Atlanta realtor. Yes, again, Christina is a great realtor in Louisiana. So if anybody's shifting to Louisiana, no smile in Louisiana, real estate wise, reach out to Christina Smallhorn and also follow her YouTube channel. She has, I think, close to like 300 something subscribers on her 300K. So she is a big time YouTuber in regards to real estate section, has awesome videos about real estate. So y'all need to go over there and follow her if you are not. So I'm going to dip back into this question on my phone, then I'm gonna go over to Troy's question, then I'm gonna go. My cousin said, I got a secure credit card, but I lost it because my income changed. Do you recommend I go to another bank/credit union to try again at 300 instead of 800? So she had got it secure. Okay.
I say yes. I don't fully understand what happened. Because typically, and I just want to make sure we're not talking about something different so that I'm not giving her advice on the wrong thing. But typically, a secured card is based on how much money you put into the bank. It has nothing to do with your employment or your income. You don't even have to have a job. They just get you to open an account. So for it to have reduced suggests that it might have been something else. But whatever it is, if you don't still have it, get another one. Also make sure, and I suggest this to everyone that's on the line, is to order your credit report so that you know exactly what's on there. You can get one free annually through My Free Annual Credit Report or something like that. Google it on how to get a free credit report. And of course, if you're like a lot of us and you don't want to go through the steps or the process, you can call me. And I can also run what's called a soft pull credit report, which means it won't mess with your existing score, but it will tell us exactly what's on there and will allow me also to create for you a blueprint of some things that you can do very easily, quickly, that can change the score to your benefit. All that stuff is free that I do every day because it's part of my job.
Okay, so we're going to go here. Troy said, I think we kind of answered this earlier. What's the optimal credit score for the lowest interest rate?
Well, interest rates, scores range from 350 to 850. The closer you are to 850, the better the interest rate. Of course, anytime you're past over the 800 mark, that makes a difference as well. Typically, you want to be somewhere about 780 or higher. Because keep in mind, it used to be not even a year ago, but maybe a little bit over a year ago, the highest score used to be less than 850. So as they keep moving the score, your great credit that was 750 last year is not as great this year. So just keep in mind and just try and pay your stuff on time. But there's always different options based on different criteria. And that's really what our job is as loan officers and realtors, is to look into your situation and figure out what it's going to take you to get where you need to go. And I think going back, Devon, to when you were saying earlier, some people just don't ask the question. And I think and understand from a large part, people feel like they're going to be judged. And they don't want to be judged, especially if they're asking something about, credit in one breath, and then the next thing they're asking you for a $300,000 property. They sometimes can't connect that. We don't care. Our job is very clear. Our job is one mission: to get you into a house legally and safely. That's it.
So that kind of goes hand in hand with that kind of goes hand in hand with James Price. What exactly is the lender's role when buying a house? So
a good lender is going to be somebody that knows exactly where all of the pitfalls are, that know what's coming ahead, that can manage the process. A lot of people think it's about, making the numbers work and paperwork, and that's important, but that's only important on the first phone call. After that, it all gets passed over really to administrators that support the paperwork that we put together. So our job is very specific in managing and being part of a bigger team to make sure that the realtors are updated so they know what's going on so they can best represent you because they're the initial client. And our job for you is to make sure that you know what the best loan is, that you understand what your monthly payment's going to be, that you know what's going to happen at closing, that you understand what underwriting is, that you understand what conditions are, and really to stop you from jumping off the bridge because we know how the movie ends. The movie ends with you in a house. It is a very stressful process that I would not suggest for anybody to try and do by themselves. And I would also suggest that you do it with someone that has a certain knowing, confidence, and calmness about the process because it's going to be stressful. I don't care how good your credit is, how good your employment is, how much money you have. This process is stressful because now, based on all the things that happened back in 2008 and those kind of things, unfortunately, they start from a position of you're guilty, and then we have to prove you backwards. That you're not trying to falsify records or live in New Jersey and buy a house in Georgia and say that you're going to go to work every day and that you're using real money. So those are the jobs to keep you out of trouble and also to make sure that you know what's coming up so that this process can be good because it's one of the biggest ones that you'll ever make in your entire life.
Exactly. Kenya said, "You both are helping me so much and making homeownership less intimidating. Don't allow homeownership to be intimidating. Like I said,
it is though.
I know it is. I'm like, but it's always great to, like I said earlier, just ask questions, get as much information as you can. Don't overwhelm yourself with what they call analysis paralysis, because I know sometimes you can get so much information, become so overwhelming that you do nothing with it. That's like I tell people when I go to a restaurant, if I see these big menus and it has so many options on it, I'm like, I don't even want enough of it. And I'll just revert back to like what I usually always get because it's just too much information. So it's like you take in what makes sense. Don't over analyze. Don't create a spot where you get stuck and just move along in the process to get to your ultimate goal, right? If that is home ownership, because everybody doesn't want to own a home, and it's okay. Do not feel like you have to own a home, right? But it is a great a way to in the future create a great space for your family and something that you could pass along generations to come, right? So,
right, I agree with you.
So I have another question. I know we kind of almost at the end of our time. If you guys have any more questions, please put it in the box, in the chat box. You're gonna have to have Demetrius back on here because I didn't even ask you.
I was gonna ask you if you please will.
Yeah, I will, because I didn't even ask you all the questions that I had asked you in the beginning that we talked about prior to coming on. But
yeah, I would love to come back.
Yeah, so Lang, she had more in regard to the secure card. She said, it because I didn't make the payments. Does it affect my credit? So she didn't make the payments to the secure card, so she lost it. Does that affect her credit?
Okay. Things happen.
Mm-hmm.
Things happen. Of course, it affects your credit. The whole reason we got the card is because we wanted to show them that you can pay things on time because you didn't really have credit before that demonstrated that. But so now what that says is that you need a reset. The reset needs to look like you getting another card. And keep in mind, I should have mentioned this, and I thank you for your question because it reminds me that I didn't say it earlier. The purpose of the secured credit card is to show that you can have credit without using credit. So whatever you put down in terms of the amount of money you put as your deposit, if it's $300, as you mentioned, then you don't want to be more than 20% of that outstanding balance or that high credit available to you. So that means if you get a $300 card, that balance is never going to be more than $60. And that's how your credit score starts to move. Because when you use it at the max, they believe they believe you're living on credit, and that's why that would be another reason that they will bring it down, but not on the secured card. And probably what they really did, the good news is they closed your account for poor payment history, but at least you don't have a collection, because remember, that money was already sitting. It was your money already. They would just say you didn't manage it well. So I need you guys to hear that when you have these credit or whatever credit, I'm telling you from as a person that's been in trouble myself. So believe me, I'm not judging. But whatever that minimum payment is, don't let it be 30 days late. I don't care if you have to call somebody and ask them, can I borrow $40 or $50 or whatever it is? Because what happens is, if you have a late today, because remember, we talked about the trade lines. We talked about the credit report, right? Well, the underwriter, that's the person that makes the final decision. And maybe our next series will talk about what an underwriter is. But that's the person that makes the final decision. And she's also doing a 2-year look back. And I say she, but it's often a he as well. But they're doing a 2-year look back. So they're looking at what your score is, 620. And they're also looking to see how did you maintain your payment history for the last 24 months. They're looking for no late payments. So where you think you just had a late payment last month, oh, well, I'll get back on track next month. No, you potentially have put yourself back 2 years. Whereas you could have called mom and them and borrowed $50 and got that money there, because that's going to predict what's going to happen in the future. But things happen. And if something happens, we start over. It's okay.
And like you said, this is this channel, that I developed over here with Clark channel as far as around real estate. This is a no judgment zone, right? I personally gone through credit issues myself too, right? And no one's perfect. Things happen in life. And as we do, we're resilient, we're human beings, and we bounce back. So myself, when I was around college, I had a great credit score, co-signed for something, and moved away, and my credit score got messed up. And I had to rebuild it. Because I wasn't personally buying a house at the time, I did do the secure credit card. However, for some reason, I don't know if this was supposed to happen, but the Bank of America at the time, they actually put the money on the card for me. I didn't use my own money, which I don't know how that happened.
That's not an unsecured credit card, Mr.
Okay. Oh, unsecured. Okay. So yeah, so they put the money on it for me. But I used it a little bit, but I didn't overuse it per se. Like you said, within that percentage range, because I didn't really need the card. I was just trying to rebuild credit. But then on top of that, too, I had actually bought a car. I know if you're trying to buy a house, you probably don't want to buy a car in the midst of buying a house because you have those big tree lines open and that triggers stuff and the debt to income ratio, blah, blah, all that stuff per se. But at the time, I wasn't buying a house, so I bought a car and I made my payments on time. I actually overpaid, and then I paid it off within like 6 months. So that helped really jump my credit score quickly. But again, everybody's way of doing stuff is different, and it depends on what your main goals is in life. But from that and the car, and then I also started my own business, I was able to then get business credit. A lot of it kind of helped my credit score bounce back. I was at I think I went to 570-ish, and then I went back up to an 820. So, but I wasn't, it was like I said, everybody's different and everybody's circumstances different. So it just moved differently. So one more thing, Lang said, thank you. I will get another secure credit card. Do you assist in another state? She said, I'm in Delaware.
In where?
She's in Delaware.
Oh, Delaware. I thought you said Delaware. Okay. We don't do Maryland, but in terms of getting prepared for a mortgage, in terms of the credit standards and those kind of things, and possibly somebody that I could refer you to once we get you ready, I could certainly help you with that. The most important thing is we want to get your credit back to where it needs to be, and then finding somebody will be easy. But I'd be happy to
So
help.
she's in. Okay, she's in Delaware. So you heard that, Lang. So once you get that back to where you want it, where it's going to be, not supposed to be, where it's going to be, because God said you want to, get a house. So James said, if I do to buy in Georgia, you will be my lender. Thanks for the information. Okay. I guess if I decide to buy, he will be in there. So yes, we have. Huh?
Something about that Clark name. Thank you, sir.
Yeah, we have a strong name. If anybody don't know, James is my dad. That's my dad. So Lang said thank you. Yeah, so we are at close to overtime per se. We said we would go an hour. I appreciate you guys jumping on here live tonight. We're definitely gonna get Demetrius back on here. So more questions. If you guys have more questions, like I said, after this is over, if you are watching the replay or you just want to go back real quick and grab his information, I'm gonna put his email address and everything inside that information thing underneath of the video. I forget what it's called. But yeah, I'll put it there. So if you're watching the video, whether back or you just want to go, you were on the live tonight, you want to jump in just to grab his information, I'll put his email address there, and we'll see him another time for more questions.
You have a great audience. Thank you. Thank you for great questions. I hope anybody that's serious about buying a house or that just wants to get serious will give Mr. Clark a call. I think you'll be pleased. I know you will.
Oh, well, thank you. And vice versa. Thank you, Miss Camilla, for jumping on.
You do your work. Hey, Miss Camilla.
Yeah, and then thank you, Kenya. She said thank you to you as well. So yes, we appreciate you. Yes, we appreciate you guys jumping on. And like I said, we will see you next time. All right. So you guys have a great Sunday night. Get some good rest and get up tomorrow and get that work week started.
Thanks for educating the world there, Devon. We need it. Thank you very much.
No problem. No problem. All right, you guys. Take care.
Talk to you later. Bye.